Hi guys, and welcome back to Beyond Alpha. I don't know whether you noticed, but Societe Generale, one of the leading financial group in Europe, just released a critical alarm with regards to the valuation of the NASDAQ. They are ringing the alarm bells with regards to the possible bubble burst within the US tech sector that potentially lead to a NASDAQ crash. So stay tuned, because in this video we're gonna dive into the details of their press release. Plus we are gonna cover the current valuation of the Magnificent 7 according to my personal methodology. And now Alpha family, brace yourself because we are gonna kick off. Societe Generale Chief Global Strategist Albert Edwards recently highlighted growing concerns over the inflated valuation across the US tech sector. He points out that the current market conditions resemble previous periods just before market downturns. The NASDAQ Composite, that is one of the leading tech-heavy indices, has shown remarkable growth, and this is undoubtful, driven by big players such as Apple, Microsoft, Google, Meta, Nvidia, just to mention some of them. However, SoGen flags that this growth is not sustainable. Notably, the fast rise in stock prices, especially post-pandemic, has led to valuations that are extremely high compared to the historical average. And this scenario can lead to a potential downturn similar to what happened during the dot-com bubble in the 90s and early 2000s, triggering a substantial market correction. Several indicators can indicate that the tech sector is in a bubble. First up, the price to earning is at historical heights, indicating that the rise of prices is far outpacing the growth of the earnings. And just to mention one of the biggest investors of all time, Peter Lynch, we should expect convergence between the prices and the earning generation potential. Or at least we could expect so in the medium-long term. As a second point, we have to mention that the Federal Reserve interest rate hikes that aim to fight inflation in the first place could put additional pressure on those valuations by increasing borrowing costs and reducing the disposable income for investments. Third point, there is a growing concern about the potential earning generation of the companies, and this applies mostly across the board. Even if Societe Generale mentions that the innovation, most notably with regards to the artificial intelligence and the digital transformation, have fueled all-in-all growth, there are limits on how much this company can grow. Long story short, if the bubble bursts, the implication can be far-reaching, and a correction of the NASDAQ can lead to a broad market sell-off, triggering a sort of domino effect, affecting not only tech stocks, but also the other sectors. And ultimately, this can have a ripple effect on the global economy, because we know that the economy and the financial markets are deeply interconnected one another. So if one of the columns collapses, also the other may start crumbling a bit. Societe Generale concludes that investors, especially those one heavily exposed towards the tech sector, should prepare themselves on the possibility to face substantial losses. So for them, it's important to reassess their portfolio and look for diversification, for instance, and perhaps considering also more defensive stocks, as well as alternative asset classes such as bonds or commodities. So just to wrap it up, until this point, we can say that Societe Generale is not really bullish on the tech sector, the other way around. However, it is also important to notice that no one out there has a crystal ball, so nobody can predict the future with absolute certainty. But we have always to reason with our minds and leverage on our analytical capabilities. This is also one of the reasons Warren Buffett never reads market commentary, because of course they can be informative but also can be misleading. And according to my personal perspective, we have to be able to use our discretion in order to understand what is the strategy that fits the best with our own nature as investor, but also as trader eventually. Let's deep dive a bit in the current market valuation of the Magnificent 7. I'm gonna leave the quick model I developed for the valuation of the Magnificent 7 in the description down below. So feel free to download it and use it for your studies or for additional analysis. But be aware that this is not a financial advice and is just for academic discussion. Plus, we have to be aware that before deciding to invest, we have first of all to understand the business, as our friend Warren used to say. So my point here is to teach you how to interpret the financial information that we see in the news and take informed financial decisions on your own. But now let's begin. Let's focus first of all on the price earning and the price to book value, that are two of the most commonly used indicators out there. Just to make it quick, the higher the ratio, the higher are the expectation of the market towards the growth potential of the company. First up, we can see immediately that the price to earning valuation looks higher than the market average. Most notably, the price earning of the 7 stocks trades between 44 times and 34 times, with regards to the actual data and the forward-looking estimates respectively. In this regards, we can mention that a lower forward price earning compared to the actual data may indicate that analysts expect that the company can grow within the current valuation, which in a positive scenario corresponds to an expansion of the net profits. And this is a plus. That said, we have to say that the current market valuation trades higher than the current market average. And just to make an example, if we take the Standard & Poor's 500, the total price earning as of July 2024 stands to 29 times. That is already pretty high and exceeds the historical average of 15. So in other terms, we have to deal with valuations that are already twice as much the historical average. It is also true that the tech sector tends to trade at higher price earning valuation compared to other more traditional sectors, such as the industrial, for instance, most importantly driven by their higher growth potential. This is also one of the reasons they are called growth companies in general. Be aware that in any case, higher valuation also imply higher degree of riskiness, because your margin of safety decreases. The same conclusion comes with regards to the price to book, which is the ratio that compares the market valuation against the accounting valuation of the company. Here the average ratio stands to 22 times versus 5 times of the S&P 500. Also under these respects, pretty high. If we pay attention to the nitty-gritty details on the other end, we can see that among the 7 companies, the one that is present in the higher valuations is Nvidia, with 69 PE and 59 price to book, while the cheapest are Alphabet, the parent of Google, and Meta, both trading at 27 PE and 8 price to book. Okay, now that we have this data, we can wonder how the investment bank analysts appraise the overall market, whether they are still bullish or they turn to be bearish. Well, surprisingly, my former colleagues are still bullish. The earnings per share forecasts are in the ascendancy compared to the trailing 12 months data, and this applies to all the companies but Tesla. However, they expect an EPS increase of about 37%, not peanuts. To conclude, with regards to the approaching earnings season, what we can clearly say is that also the consensus estimates for the second quarter 2024 are higher than the data reported in the same period the previous year. But also this time, Tesla comes up as the outlier, together with Nvidia, that are expected to experience an EPS drop. So here's the thing, the current valuation is not cheap, but I expect a really spicy reporting season, and I tell you why. First of all, the earnings per share is going to be an indication about the economic growth and about the financial sustainability of the tech sector business model. Secondly, there are 2 elephants in the room that are the interest rate policy going forward, and last but not least, the US presidential elections that can impact massively the stock performances from this point in time until the end of the year. And my tip in this light is to focus once again on what we can control, that is the business itself, not to get fooled by temporary market swings. Because knowledge, patience and consistency are the best weapon we can use in order to perform well on the stock market, being de facto independent from what the various gurus can say. In conclusion, while it is impossible to predict the stock market with certainty, the warning from Societe Generale should not be taken lightly. Investors should be vigilant and consider the potential risks. As always, stay informed and prepare can help navigate these uncertain times. So guys, we reached the end of the video. If you like the commentary on the Societe Generale call and the exercise on stock valuation, don't forget to like, share and subscribe for more insights and updates on the financial market. Of course, here on Beyond Alpha. Don't forget to let us know what you think in the comment down below, and feel free to download the Excel model in the description. In the next one, cheers!